I am ready.
Great. Hello, everyone. Welcome to the webinar Tax Implications of the 2020 Presidential Election and 2021 Strategic Tax Planning and Updates. This webinar is being presented through the South Windsor Chamber of Commerce. My name is Marc Finer, and I am pleased to be joined by my co-presenter, Mike Blezard. I am the chair of Murtha Cullina LLP's tax practice group. I'm a tax attorney. I provide effective and innovative tax planning for a whole host of entities and regularly advise clients on controversy matters with the Internal Revenue Code and state and local tax authorities. My co-presenter, Mike Blezard, next slide, is a partner in charge of business valuation and litigation support with the accounting firm Paycheck, Leibowitz Blezard LLC. His expertise is general business consulting. Mike is a certified public accountant as well as a certified valuation analysis. I want to thank you all for being here today. You could have been anywhere at this time, so the fact that you're taking the time to be with us is very much appreciated. Today, just as an overview, we are going to go over some provisions of the CARES Act that was enacted in March of 2020. From there, we are going to discuss some of Joe Biden, President-elect's tax reform proposals, as well as state reactions to some of those proposals. And lastly, we are going to talk a bit about the Consolidated Appropriations Act, which most people just know as the recent stimulus package that was just enacted into law at the end of December. So with that being said, I also want to say that for anyone that has questions, you can use the Q&A box to ask those questions, and to the extent we have time at the end of the webinar, we will do our best to answer those questions. But if not, we will work with the South Windsor Chamber of Commerce to circulate the slide deck to anyone that has joined us today. And the contact information for both Mike and me are on the front slide of the slide deck. So if you have any questions that we have not been able to get to because time has run out, you can certainly reach out to Mike, and you can certainly reach out to me, and we'll do our best to get back to you with answers to your questions. That being said, let's get into it. Next slide, please. So as I said, the Coronavirus Aid and Relief and Economic Securities Act, known as the CARES Act, was passed in March of 2020. And some of the business provisions of that act were the Employer Retention Credit, which provides a refundable credit against 50% of qualified wages paid to employees whose employers have experienced a full or partial shutdown as a result of a government order, or who have experienced a greater than 50% reduction in gross receipts. And the credit is paid through a reduction in the payroll tax deposit that the employer would otherwise have to make to the IRS with regard to payroll taxes withheld from employee wages. And we're actually going to come back to that a bit later, because that was actually expanded. It became more favorable as a result of the recent stimulus package. Another provision of the CARES Act was the delay in employer payroll deposits. Eligible employers and self-employed individuals could delay the payment of 6.2%, which is the employer portion of Social Security taxes attributable to employee wages, through December of 2020. Another favorable provision for businesses from the CARES Act was the expanded net operating loss provisions. When the Tax Cuts and Jobs Act was created or enacted in the end of 2017, one of the things it did was limited post-2017 NOLs to be able to offset only 80% of income rather than 100% of income, and it eliminated the ability to carry back net operating losses to prior years. Under the CARES Act, NOLs generated between 2018 and 2020 could be used against 100% rather than 80% of taxable income for those years, and excess NOLs could be carried back for up to 5 years. Another change by the CARES Act was the acceleration of the alternative minimum tax credits. Under the TCJA, the Tax Cuts and Jobs Act, the corporate alternative minimum tax was eliminated, but a number of companies had AMT credits that they were allowed to use. Under the TCJA. They were allowed to carry those credits over a term of 2018 to 2021. Under the CARES Act, those credits, the availability of those credits were accelerated. So you could use them as quickly as 2018 and 19, or elect to use them all in 2018. And next slide, please. The CARES Act also provided for a temporary increase in business interest deduction. Under the TCJA, business interest deductions were limited to 30% of taxable income. Under the CARES Act, that percentage was increased to 50%, so that businesses were able to deduct business interest expense for 50% of taxable income for the years 2019 and 2020. Increased charitable contribution deductions, the 10% limit on corporate charitable contribution, the 10% limit for corporations on charitable contribution deductions, that's 10% of taxable income, was increased to 25% for 2020. And under the new stimulus package, that was actually extended to 2021 as well. Qualified improvement property, that's defined, for those of you that don't know, as improvements made by a taxpayer to the interior of a non-residential building that's placed into service. And the problem was that through a glitch in the TCJA, that type of property was considered 39-year property, and as a result, didn't qualify for 100% bonus depreciation. The CARES Act changed the depreciable life to 15 years, which essentially brought it within the category of assets that could qualify for 100% bonus depreciation. Paycheck Protection Program loans, the forgiveness of those loans is not subject to federal income tax. Normally, when you have loan forgiveness, it's treated as cancellation of indebtedness income, and is treated as income to the taxpayer. Excess business losses, under the TCJA, business losses were limited to trade or business income plus $250,000 or $500,000 for joint filers. For 2018 to 2020, the CARES Act changed that, so that business loss limitation was not applicable. And so you say to yourself, why is Mark telling us about things that we could do for 2018 to 2020 when here we are in 2021? And it's a great question, but the reason that I'm telling you that is because the CARES Act provides an opportunity to maybe re-examine tax returns that you have filed for previous years, because there may be an opportunity to amend those tax returns and reduce the amount of taxes that you pay, for example, by carrying an NOL back to a prior year rather than only using it on a go-forward basis. So it's certainly something that I would recommend that businesses speak to their tax advisors about, to see if there are opportunities to file amended returns and reduce their taxes. Just on that note, Mike, have you seen businesses that have approached you, or you've approached your clients about doing that sort of planning?
Yes, we've had a number of different clients that have actually carried back some losses, many of whom are pass-through entities, and those losses are hung up on their personal 1040s, and a couple of other businesses. So it's a facts and circumstance situation. We have some clients that elected not to because it's worth more to them. So a lot of it is looking at what was your marginal tax rate for the year you can carry these losses back to. And to the extent you're in a high tax rate at that point in time, it may be worth a lot to you, as opposed to if you're in a low tax bracket and the benefit wouldn't be as great as carrying it forward if you think the future is looking better. Those are some of the decisions that clients have gone through with us. But it's a great point that Mark's making. You definitely have to take a look at it, weigh the pros and cons, and then come up with some sort of strategy to deal with it.
Great. Next slide.
Okay, so I guess I'm taking this portion, the
Interrupt, Mike.
political landscape. Obviously, very challenging. The last week or so, a lot of stuff going on. We certainly know who the next president's going to be, irrespective of what some people believe. President Biden is going to be in on the 20th, and that's the way it's going to be. The current makeup of the Senate switched just recently based on the Georgia runoff elections. The two Republicans lost their races and were replaced by Democrats. So now we have a 50-50 makeup in the Senate. And as you may or may not know, the Vice President of the United States is the tie-breaking vote. So certainly, I think, it's split down the middle, but they can get a majority of 51 to 50 with any close votes, whether or not that's enough to get something through. And the House remains under Democratic control. A couple of seats lost there. I think the Republicans picked up a couple, but by and large, it's controlled by the Democrats. So we have a Democratic president. The Senate with the vice president's vote is Democrat, and the House is Democratic. So it's ripe for perhaps some tax policy to change in the future. I don't think right away that's going to be President-elect Biden's first order of business. I think he's going to be looking at the stimulus. There's a lot of speculation as to whether or not there's going to be some additional payments made. There's talk of the $2,000 per individual and qualified family member that you would get some additional money for. There's a lot of talk about what the states will be getting in the way of some assistance from the federal government, and some other things thrown in there, like perhaps forgiveness of student loan debt. There's certainly some talk of 10,000 up to 50,000 of that type of debt being forgiven, and a couple of other things. So I think first and foremost, he's going to be focused on additional stimulus, and certainly everything's laid out where it's right for that to be presented and to go all the way through and be signed into law. So that may be the first thing that he's dealing with. And secondly, and concurrently, the pandemic, he's going to have to deal with in the economic fallout of that, and the vaccination rollout, and trying to get that under control. So I presume that's going to take up a fair amount of the 2021 year for him. And he is on record with what his tax policy is. So there's a possibility that tax policy could be changed for 2021. We, at least my firm and others that I've spoken to, do not expect to see anything rolled out until maybe the end of the second quarter at the very earliest, and into the third or fourth quarter. It may be retroactive to the beginning of the year. It's one of those years where it's going to be very hard to plan to figure out when any changes, if he is able to pass some, will take place. But if you can switch to the next slide, we can talk about some of the tax attributes that exist today. And I'll discuss some of the details of President-elect Biden's suggestions as to what he's planning going forward. So right now we have the Tax Cuts and Job Act taxes are in play. And you may or may not recall, but this was passed in 2017. It became effective for 2018, and it basically brought down the individual tax rates from the highest marginal rate prior to this law of 39.6% to the highest marginal rate for an individual down to 37%. What also changed with the change in the rates was the amount that would be subject to those higher rates. In the past, once you made up over a little over $400,000, you were subject to 39.6% for federal purposes. With the new TCJA, until you're making over 600,000, you wouldn't hit that 37% rate. So as you can imagine, some high earners certainly ended up getting somewhat of a windfall, and taxes were lower for them. That's in play right now. President-elect Biden is certainly on the record to tax individuals making $400,000 or more and putting them back into that 39.6% tax bracket and eliminating certain other benefits that they have. So that's clearly one item that he has, and that is part of his agenda. Whether or not that can pass this year, it's to be determined. On top of that, he's also looking to expand Social Security tax, both on the individual and the employer for people that make over $400,000 a year. Right now, you have Social Security that's tied into a base of about $137,000, and then that tax goes away. So from 137 up to the 400,000, there's what they're referring to as a tax hole, a donut in the tax code if he passes his new legislation. And then once you get up to the 400,000, then it kicks in again for those individuals. Moving on to lower corporate tax rates. Tax rates for corporations went down to 21% with TCJA. Biden's on the record for increasing that up to 28%. So that's a potential increase that may be coming. The 20% qualified business income deduction for self-employed and owners of pass-through entities, that's a nice benefit for people that are sort of in the sweet spot, not the high earners and not the low earners, but that has reduced taxation for, a great deal of people. That is going to start to be chipped away at with some of Biden's changes that he's suggesting. The increase in federal estate and gift tax exemption. Joe Biden has mentioned that he would like to cascade back to the 2009 rates. It's roughly $3.5 million exemption per person is what he was looking at, and bringing the marginal rate for transfer taxes back up to 45%. If he can get that passed, that's always subject to negotiation back and forth. The global intangible low tax income, that's probably not applicable for a lot of the audience here, but that's going from roughly 10% to doubling to 20%. It's not applicable for a lot of people. Accelerated depreciation, that's a nice benefit. That may be tampered with just a little. Elimination of the corporate AMT that we have under the Tax Cuts and Job Act. We're going to go back to, at least for companies of $100 million or more, that there will be some book AMT limitations and some other things that will be dealt with. Under the current tax law, there's limitations on your itemized deductions. A lot of people that live in high tax states like Connecticut, where you have high real estate tax, high income tax, high personal property tax, all of those combined for you on your tax return was limited to $10,000, even if you paid a lot more, as well as some itemized deductions for interest and a few other things. And charitable contributions, if you couldn't get over the standard deduction, which is fairly high in the $24,000 to $26,000 range for married filing jointly, and based on your age, you got a fairly good deduction. But if you were much higher than that in the past, you've lost out a little. Certainly, we'll talk about some of the workarounds that states put into place that helps out some small business owners, especially in Connecticut. Connecticut, they put that pass-through entity tax into play, and we'll talk about that a little later. Joe Biden is also, talking about phasing out the like-kind exchanges and doing away with that, and the qualified opportunity zones. there's going to be a lot more work associated with proving that you had some sort of social impact for the credits you're getting in the tax-free zones that you're in, as opposed to what's under the tax Cuts and Job Act right now. So maybe we can move on to the next slide.
So we can, so now we're going to get into a little bit more of the details. Mike gave a fantastic overview of, some of the changes. We're going to get a little bit more into the weeds now. But, it's really just, the point of this is to make you aware of some of the changes and, help you to maybe plan should some of these changes actually be enacted. So next slide, please. So on the individual side, as Mike said, under the TCJA, the highest marginal income tax rate was for individuals was reduced to 37%. And just keep in mind that a lot of the provisions of the TCJA on the individual side sunset after 2025. So that means that they disappear and we go back to the tax rules that were in place before the TCJA was enacted. And one thing you're going to hear over and over when you hear about Biden's tax reform proposals is this $400,000 number. And basically what he said is if you earn less than $400,000, none of his tax reform proposals should affect your tax situation. You shouldn't be paying any more in taxes than you were if you make $400,000 or less. So one thing that Mike talked about is restoring the top tax rate to 39.6%, which was the tax rate pre-TCJA for individuals earning more than $400,000 in a given year. And one thing that's still unclear is whether that $400,000 applies just across the board, meaning if you're married filing jointly, whether it's $400,000 as a joint couple, in the same way it would be, for a single filer. He hasn't actually said one way or the other how that $400,000 threshold amount is going to work. Another important change he is proposing is currently long-term capital gains, gains on the sale of capital assets that have been held for more than a year, and qualified dividends. The tax rate is currently 20%. He would increase the long-term capital gains rate and qualified dividend rate to the highest, ordinary income tax rate of 39.6% for individuals that are earning more than $1 million annually. And that could impact a number of industries. There are a number of industries where you actually have to market your assets every year and pay tax on any appreciation, regardless of whether you've sold the asset or not. We have actually had some clients who have accelerated transactions into 2020 for fear of this piece of Biden's tax reform being implemented in 2021. And when you think about it, you sell your business for $10 million. Well, if you sell it in 2020, you're paying $200,000 of federal income tax. You sell it in 2021 and the rate is increased to 39.6. Instead of paying $200,000 in tax, you're now paying almost $400,000 in tax. Mike, have you seen any of your clients or did any of your clients accelerate any transactions as a result of fear of this rate going up?
Yes, there is a number of different individuals that anticipated rates going up, and if they're in control of accelerating income into 2020 or postponing expenses into 2021, there was a handful of them that did that.
Okay. So as Mike touched upon in the previous slide, owners of pass-through entities essentially get to reduce their taxable income by 20% before calculating their federal tax liability. So if the business made, or if the owner of the business received $100 in taxable income from the business, the owner could reduce that $100 by $20 and pay tax on $80. That 20% qualified business income deduction phases out for certain high income earners of certain professions. So professional service industries, the QBI deduction phases out for owners of those industries that make over a certain amount. Unfortunately, it's firms like accounting firms like Mike's and law firms like mine that are subject to this phase out. So what Biden proposes to do is make that phase out applicable not just to professional service businesses, but to all businesses. So owners of all businesses that earn more than $400,000 from that business would have that QBI deduction phased out. Next slide. Mike talked about Biden proposing to maybe limit itemized deductions. And again, it's to limit itemized deductions for individuals earning more than $400,000. He'd also restore this, what's called a P's limitation, which essentially reduces the value of itemized deductions for high income for earners. So he would implement that as well. Biden would also, part of his reform, limit the tax benefit of itemized deductions to 28%. And what would that do? That would primarily impact taxpayers in the 32% and above tax bracket, because for high income earners, their final dollar of income could be taxed at 39.6%, while the final dollar of expenses would only give rise to a 28% deduction. So even with the deduction, you're still paying tax on 11.6% of your income. The elimination of the SALT deduction, that's actually been more of a Democratic, a proposal of the Democrats than Biden, but Biden has said that if it gets to his desk, he would definitely consider signing legislation that eliminates the SALT deduction, that eliminates the limitation on the SALT deduction. Mike touched on the fact that a 12.4% Social Security tax is imposed on for 2021, the first $142,800 of wages. Joe Biden would also impose that 12.4% tax on income earned by somebody in excess of $400,000. And, as Mike talked about, that creates a donut hole, because your first $142,800 of wages and your wages in excess of $400,000 are subject to this 12.4% tax, but the amounts in between are not subject to this 12.4% tax. But what you also have to realize is that $142,800 of wages is indexed for inflation every year. So every year, the amount subject to the 12.4% tax grows, and eventually it would meet up with the $400,000 start to additional Social Security tax. So if nothing is done, meaning if the $400,000 is not also indexed for inflation, over the course of time, as you can see or imagine, all of your wages become subject to Social Security, this 12.4% Social Security tax. Next slide. Just some other things to touch upon for individuals. Joseph Biden is proposing a first-time home buyer credit, and that would be a $15,000 refundable and advanceable credit. And I actually had to look this up because I didn't know what a refundable and advanceable credit was. I don't know if Mike knew what it was, but I did not. So it means that home buyers receive a refund if the credit exceeds their tax liability, and they don't have to wait to file their tax return in order to claim the credit. They can claim the credit when they buy the house. Just a couple other things: increases in some child and dependent care credit, and an increase in the child tax credit. Plus, with that, it would be increased to $3,000 per child, with an additional $600 for children under the age of 6. Next slide, and Mike, take it away.
Yes, some of the key Biden proposals at the corporate level, I touched on them briefly. The current law is a 21% tax bracket. A lot of this was instituted to bring some foreign monies back into the U.S., as well as bringing more jobs back to the U.S. to get the U.S. corporate tax rate more in line with some of the international rates that a lot of the companies were moving out to. Biden's proposal is to bring it up to 28%, which is certainly lower than the 35% bracket that existed prior to the change that was made with the Tax Cuts and Jobs Act. So both are still bullish on trying to bring business into the country and to keep corporations doing fairly well. Just a slightly different approach between the two. Right now, there's no corporate alternative minimum tax. Joe Biden is proposing a 15% minimum tax on U.S. corporations that report book profits in excess of 100 million. And a lot of it is just to make sure that what's happening on a company's tax return versus what their financial statements look like. There's limitations that don't necessarily hurt the U.S. government when it comes to collecting taxes from these entities. So, it's a balanced approach. There's different ways to accomplish the same thing in the end. Now with the current law, no Made in America tax credit, Joe Biden is proposing a 10% credit for expenses related to domestic manufacturing and some other things. So he is big on bringing manufacturing back. I believe President Trump was fairly big on that as well. I think the two of them see the benefits of bringing the manufacturing base back into our country just because of the multiplier effect. When you think of a service business person, for each job for a service person, they maybe generate another job for someone else, but for manufacturing, every one job that's generated, it usually has a multiplier effect of about 2 to 3 additional jobs for other people to do. So that's just a good overall policy for the country to get everyone working again. If we can move to the next slide, please. Some of the international stuff, I spoke briefly on some of this, and it's probably not applicable to anyone that we have in the audience here today, that global intangible low tax income. That's, unless you're doing things overseas and you have a lot of stuff going on, you probably haven't seen it. Biden's just going to double it. I think what President-elect Biden's trying to do is to bring more of the manufacturing back into the U.S. And, this is the way he's incentivizing people to do that, because your taxes may be lower if you're within the company versus doing things outside. Current law with no direct or indirect incentives or disincentives on sales to U.S. customers from foreign entities. He's going to, President-elect Biden has a 10% surtax on profits from U.S. companies at manufacturing products offshore. So as you can see, it's just trying to bring more of the manufacturing base back into the U.S. And I think when you look at some of the political divisiveness that you see out there, it's a lot of people feel as though some of the manufacturing base in the past has been depleted. It's been moved offshore, and those are good middle income jobs for many Americans. They're well paying, they last forever usually, and they want to bring those back into this country. And this is how they're incentivizing that. We've become mostly a service type economy to a great extent, and we still have a large manufacturing base, but at one point we had a much larger base. So I think it's in everyone's best interest to bring some of the manufacturing back. The only people that I see being hurt may be the people that run the large corporations that may have to earn a little less based on paying a little more in the U.S., but that's the way it just may be. So it also right now, there's no direct or indirect incentives or disincentives for moving jobs overseas. Right now, President-elect Biden wants to have, something clawing back provisions for companies to invest in tax benefits when U.S. jobs are sent overseas. So it's a disincentive to move them and to keep them here. And I personally think it's pretty good tax policy to try to keep the jobs here if you can, within reason, because we operate within a global economy, not just the US. So you have to make sure that everything fits into what's happening worldwide. But I think with the US know-how and technology and persistence, we can get manufacturing to be as efficient as it needs to be profitable. We just need the right tax incentives in place and the right people behind the companies making sure that we do everything we can. So a couple of good proposals there, not a great deal different than the others. I think both are trying to achieve the same thing, but different approaches to getting it done. And
next slide. So just to touch on Biden's estate and gift tax proposals. So right now, under the TCJA, you're actually allowed to give away assets worth $11.7 million this year and $23.4 million for married couples through either in death or through gifts while you're alive, and that will be the case through 2025. It's one of those provisions that sunsets after 2025. Biden is proposing to reduce that exemption, the $11.7 million to $3.5 million per person for estate tax purposes and $1 million for gift tax purposes. He's proposing to raise the federal, state, and gift tax rate, the highest rate, from 40 to 45%. And maybe one of the biggest benefits, well, I should say, when we sometimes advise our clients, if you die, this will be a great tax result. I'm not telling you to die, but if you do, this is what will happen. What happens when a person dies is their assets are stepped up to fair market value. So just to give you a simple example, I buy a share of Google for $100, and I pass away when that share of Google is now worth $1,000. My beneficiary can sell that Google stock the next day and have no gain on the sale, because at my death, that $100 cost basis that I had in that share of Google stock increases to $1,000. So when it's sold by the beneficiary the following day, they receive $1,000 in cash, and their cost basis for purposes of determining the gain is also $1,000. No tax. Biden is thinking about proposing, or he's actually proposing eliminating that basis step up, so that beneficiary of the Google stock receives that stock with a cost basis of not $1,000, but the same $100 basis that I, as the decedent, had in the stock, such that when that beneficiary sells the stock, that beneficiary recognizes the same $900 gain that I would have recognized had I sold that share of stock a day before I died. What's unclear right now is whether the Biden would allow for the step up, but by providing the step up, also essentially taxing the beneficiary or the estate on all of the appreciation that occurred with respect to the asset during the decedent's life. And when you think about it, when you combine that with something we talked about previously about the tax rate being 39.6% for income over $1 million, if you have assets that have appreciated to the point where taxable gain on that mark to market on the death of the decedent would be in excess of $1 million, well, you now have to pay capital gains tax, not at the 20% rate, but at that 39.6% rate. And that could be a big problem for estates that have a lot of non-liquid assets. So if you inherit land and that land is worth way more than it was purchased for by the decedent, well, now you have a big tax hit, but land is not a liquid asset. So where are you going to get the money to pay the tax? This is all still unclear, and it remains to be seen whether that particular proposal actually is passed. Next slide. Just touching on retirement contributions, as many of you may know, contributions to pre-tax contribution plans are fully deductible, And that provides a greater tax benefit to high income earners in higher tax bracket, because a deduction for a high income earner at 39.6% is worth way more than a deduction for somebody in a 15% tax bracket. So what Biden proposes to do is to equalize the tax treatment of contributions to defined contribution plans by providing a flat credit of about 26% to replace the deductions. So just giving you an example, the contributions to these contribution plans would be included in income, but an individual earning $600,000 and an individual earning $60,000 would get the same $260 tax credit for a $1,000 contribution. That's what I mean by equalizing the tax treatment for both high income and not so high income earners. Next slide.
Okay, the key Biden tax proposals on real estate. I touched on this just briefly earlier. Right now, the current law allows for like-kind exchanges. And basically what that means is if you have real estate that's fully depreciated and it's appreciated in value, and you would like to locate another piece of property, but you're hesitant and do not want to pay the capital gains tax on one transaction before you reinvest the money into the next, the current law allows you to defer paying the tax on that difference in your carrying basis versus the value when you sell it if you reinvest it into something new. It's called a like-kind exchange. So that allows many real estate investors to leverage what they have in value without losing buying power to taxes. And ultimately, a lot of times people would hold that until they passed away, then they would get a stepped up basis in everything. And then now whoever inherited it wouldn't have to pay that income tax on the capital gain at all, or any recapture taxes. And some of that's changing with what Biden's doing or proposing. He wants to eliminate the like-kind benefits for individuals earning $400,000 or more. It's a very common theme. He sort of looked at that $400,000 base threshold, and that's what he's after. And as Mark mentioned, it's not very clear as to whether or not that's a $400,000 amount for a married filing joint taxpayer or for a single taxpayer. Presumably it's for married filing jointly, and maybe for an individual, it may be $300,000. You hear people talk about the marriage penalty within the taxes. You would think that if Joe Biden was saying for an individual, you wouldn't have to get rid of these like-kind exchanges if you earn $300,000 a year. You would think, okay, for a married filing joint return, you would multiply that by 2 and come up to $600,000. It doesn't always work that way. So when they say there's a marriage penalty in there, in a way of that example, it would be $200,000 to the detriment of a married couple. But you know, love is bliss, and that's what you have to deal with. Qualified opportunity zones, they're out there, they're very good, they're very complex, but a very, very big benefit for the right type of real estate investor if you can find the properties that qualify and make it all happen. The Biden proposal leaves a lot of this in place, but it gets into doing additional benefits, you know, where it's clear economic, social, and environmental benefits to the community. So I look at it as almost being a project that you have to audit and provide a lot of additional information for the zone to actually qualify and succeed in the end. So it's just more of an administrative cost. It's just a government mandate. You know, making sure that it does achieve what it's supposed to do. There's nothing wrong with that, but there is an additional cost. So if we have clients looking at this, we have to estimate what those additional measurement costs would be, what type of specialists you would have to hire, what the consequence of detrimental findings would be, and whether or not it's something you would want to put into that type of zone and investment. So it just makes it a little more cumbersome than right now. The zones are, if you meet it up front and it's documented the right way, chances are you'll be fine in the end. But now you have to make the determination up front that it meets the requirements, but in the end you have to prove that it fulfilled clear and economic, social, and environmental benefits at the same time. So it makes it dicier and a little more challenging. So not that good for the real estate investors in real estate right now, because of the pandemic and some of the changes that have taken place with remote working and everything else and learning. What type of impact will this have on real estate? And it could be significant, especially when you have certain incentives that are out there that are going to even negate the value of putting money into real estate when demand for perhaps certain types of spaces may be diminishing at the same time. So not good for the real estate area, but they'll get through it. Can you move to the next slide, please? So we got some state reaction to COVID-19 challenges. It's all over the place. There's certain incentives that the state's looking to help with. Obviously, there was a lot of federal relief that was offered. The states, each state is a little different. We have many clients that operate in a bunch of different states. One of the biggest benefits for paying taxes and other things at the state level was the delay in the amount that you had to pay and when you had to pay it. So that bought many clients a lot of time, reduced late payment penalties, gave them more time to sort of sift through things. It was difficult because of people scrambling and leaving the work sites, being closed down by the government, and then figuring out how they're going to operate properly within the confines of what's happening. A lot of things may not follow. For instance, the federal government made many of the changes that were mentioned by Mark in relationship to carrying losses back and getting some federal tax refunds that companies could use as working capital. States will decouple from that and not necessarily allow for those carrybacks because they just don't have the tax collecting power and wherewithal to issue more debt to facilitate all of this. So there's a lot of, they don't go hand in hand, the federal law changes in the state. So you're going to see a big decoupling, and although the states want to try to do something for you, they're limited with what they're able to do. So we can go over questions if people have any specific things at the end, because everything's facts and circumstances for your specific industry you're in, the businesses that you work for, and the type of policies that the state instituted in regards to what you can or cannot do.
Yeah, I would just add to that Connecticut is thinking of actually rolling back some of the tax relief it had previously enacted. One of them is the expiration of the 10% surcharge on corporations, the capital stock tax, which is a regime for taxing corporations in Connecticut. It's supposed to be phased out. They're talking about delaying that phase out. So like Mike said, it remains to be seen how states react, because they can't just print money or borrow to get out of the financial hole that all of COVID has put them into. Next slide. So, just talking a little bit about 2021 income tax planning. If you think rates are going to go up, most likely it will happen in 2022. So let's, for the sake of the discussion, assume tax reform occurs in 2022 and not 2021 because of all the other issues that the legislatures and Congress are going to have to deal with. For 2021, you would want to pay bonuses. You would want to accelerate installment payments. If you've sold your business and there's a 10-year payout, you can elect to take all of that gain into income in the current year. You may want to think about Roth conversion, converting from a pre-tax account to a Roth account. My advice, though, would be, don't let the tail wag the dog, meaning if you weren't going to do something, don't just do it because you think, rates are necessarily going up. It has to be business decision as much as a tax decision as to strategies you should think about. Alternative investments, if you think rates are going up, maybe you change your investment mix to include some tax-free municipal bonds. Maybe if you think the capital gains rate is going up, you might want to think about changing from dividend to non-dividend producing investments. Next slide. If you think rates are going up, or if you think rates are not going up, you want to accelerate deductions. So you want to accelerate charitable contribution deductions. Maybe you bunch those deductions so that you get over the standard deduction and can itemize. Maybe you maximize your retirement contributions because to pre-tax account, because those will reduce your income. Bunch medical expenses so that you exceed 10% of AGI. So those are just some things that people are talking about, and we're advising our clients at this point. Next slide.
Okay. Now with some other ideas of planning would be postponed SALT type of payments. So right now you're limited to a $10,000 deduction on your federal return as an itemized deduction in 20. Presumably that will be the same in 21, but going into 22, if itemized deductions come back into play, you'll get a perhaps larger tax benefit of paying it in 2022 versus 2021. Restructure compensation to try to minimize your Social Security tax. If you're structured as a partnership, perhaps there's a way to restructure the business so you can put yourself on the payroll, so every dollar that you earn from the company is not subject to self-employment tax. You can limit what you need to fund your pension accordingly. And there's some planning that can always be done around that type of event. Consider triggering inclusion events for qualified zones. That's just one of the things where if the rates are lower, and there's going to be less work to prove that you fulfilled some sort of obligation in the future, even though most likely those would be grandfathered with a change in law. You don't have to worry about that, and you lock in the lower gain, or don't have to pay anything at all, depending on the structure of what you have. Consider our IRC 1202 planning. That's an area that, you know, it's probably not applicable for everyone on this call here. Roth style accounts, this gets back into different income earners. I think Mark gave a good example earlier where he said someone that puts money into their plan, a retirement plan that's making $60,000 a year versus someone that's making over $400,000. They're in different marginal tax brackets with what they're earning. So as they put dollars into their plans, obviously if there's no limitation or credits that equalize that, the person that's in the higher tax bracket benefits more by putting more into that. If that's equalized where it's not doing that much for you, putting it into a Roth style account that ultimately will build on a tax deferred basis, and when the money comes out, it's tax free, that will do much more for the saver than someone else. So that's you know, a big thing to consider. And I would say stay tuned to what's happening towards the end of the year and try to make that decision. Obviously, people that are in 401k plans at work where you can have a Roth style account, it may be a premature at this point to decide to switch from pre-tax to a Roth or vice versa, not knowing exactly what's going to happen. But as time goes on and things get clarified as to what direction tax policy will be going in later in the year, you can start to think about those types of opportunities to save money and to have things compound for you a little better tax-free. Next slide, please.
Yeah, so I'm actually going to go, let's go to slide 25, since we're limited in terms of the amount of time. You know, let's talk about the effective date. You know, now we know the makeup of Congress, and we know that the Senate is 50-50, but it's certainly not clear that, you know, every one of Biden's tax proposals is going to receive unanimous Democratic support. So, you know, I think that it's unlikely tax reform would be retroactive to 2021. I think the really larger tax reform is going to happen in 2022. I mean, we have, you know, Chuck Schumer came out today and said, you know, the first priority when Biden gets into office is another COVID-19 relief package. So, you know, we're going to see, you know, there are other priority events that probably will take take priority over tax reform. We don't know the status of the pandemic. We don't know the status of the economy. There could be other events like the mortgage crisis that require Congress's attention way more than tax reform. So it remains to be seen how quickly this reform actually gets passed. But I think it's most likely in 2022, not 2021. Next slide. One more. Mike,
All
this
right. Is this assigned to me, Mark?
it is.
Okay. That's it. Maybe I was missing a page with the assignment, but I'll go over it. PPP loans. They're available through March of 2021. The second draws are now available for people that qualified for the first one. The amount of payroll that you're entitled to is very similar to the first phase if you're not a NAICS code 72 type company, meaning hospitality, restaurants and others, they're given a little more money eligibility wise than the traditional types of companies. So it's about 2.5 times your average payroll. Most of our clients are looking at still using their 2019 pay as the qualifying benchmark to come up with what they would be entitled to if they qualify. The qualifications for the most part are that you need to have incurred in at least one of the quarters in 2020, 25% or greater reduction in your revenues for one of those periods to be eligible. And that's a calculation that you have to do. We're waiting for more guidance to come out, and I'm not sure if you've seen anything, Mark, as to whether or not it's the basis in which the applicant reports on their tax returns, because you could be on the cash basis or accrual. We tend to think it's going to be on the basis that you report for tax reporting. That would be the qualification bogey that you're looking at for revenue. Subject to change. We're still waiting for the SBA to come out with some additional guidance. Qualifying expenses are deductible, which is good. Many of our clients wanted to try to get a deduction for all of their expenses in 2020 and have their previous PPP loans forgiven in 2021, where you get a deduction and then you didn't have to pick up the income the following year because the IRS came out with initial guidance saying that you could not deduct any of the expenses related to any forgiveness. But the Congress came out and their intent was that that's not what their intent was. So the expenses are fully deductible and the cancellation of indebtedness income is excluded from income. So that was a huge win for most companies. So, for a general company that had $100,000 forgiven and now the owner doesn't have to pay taxes on $100,000, that's a huge windfall. And that's what's happening with the old program as well as the new one. Expansion of categories qualifying, that's where we have some 501c6 organizations coming through that are qualified, and certain other ones where they're relaxing who can qualify and how you can qualify, and if you have multiple locations, how those could qualify, where in the past they perhaps couldn't. It gets very complex very quickly. You have to consult an operations person within your organization and a tax person, and a lot of times a general tax counsel to get through all this stuff. It is complex. Borrowers may obtain the second PPP loan. That's what's out there right now. Most organizations have started to roll out applications where you can apply. If you did apply and receive one previous, work with that banker, try to figure out what you need to do and apply as soon as possible, because there's a potential that the money can run out, but that's to be seen. $2 million borrowing limit, just like before. Flexible coverage period, as I mentioned, you can do 2019 payroll, or you can fast forward to your 2020. And for certain other companies that are cyclical, you can pick other different periods. There's a simplified loan forgiveness process of $150,000 or less, and for qualification purposes, where you may not have to show that you had that 25% drop, but you have to make some assurances that that's exactly what happened. If we can move to the next slide.
Yeah, so I'm just going to quickly tell you about some changes to the employee retention tax credit. It was extended through March 2021. Instead of the credit being 50% of taxable wages, it's 70% of wages. So instead of a $5,000 credit, you're entitled to up to a $7,000 credit on qualifying wages. The credit can be used on wages as long as those same wages are not being used as qualifying expenses for PPP loans. It was, as I said, you had to show that you experienced a greater than 50% drop in gross receipts when comparing a 2020 calendar quarter to a 2019 calendar quarter. Now you just have to show a 20% rather than 50% reduction. You can actually get the credit for wages $10,000 per employee per quarter instead of $10,000 per year, and businesses with fewer than 500 employees rather than 100 employees are eligible for the credit. Next slide. Just some other things. Business meals and restaurants are fully deductible rather than 50% deductible for the years 2021 and 2022, and that also includes, takeout and delivery from restaurants as well. The paid sick and family medical leave, it's available through March 2021, although it's voluntary at this point. In 2020, it was required that you pay people for coronavirus-related sick and family leave. Now you can offer it, but you don't have to. President Trump, I don't know if you remember, said that employees could defer their share of the Social Security tax through April of 2021. Now they can defer it through December 2021, and economic injury disaster loan advances, which were not subject to tax, no longer have to be deductible when calculating your PPP loan forgiveness amount. And next slide, and we'll finish up.
Okay, as you may or may not know, the payroll tax deduction for the Connecticut Paid and Family Medical Leave Act started January 1st of 2021. That's 0.5% on the wages of employees. The employee pays it, the employer has to withhold it and then remit it. So the first quarterly remittance would be for the period ended March 31st, 2021. Usually the state gives you until the end of the following month, which would be April, but they're going to give one additional month for this first quarter since everything's new. They're going to build up a fund, and the eligibility for people taking these benefits and applications will not start until a year after the tax starts to be collected. So the benefits are up to 12 weeks of paid leave, and there's certain exemptions. Like anything, this is just an estimate as to what they think they need to withhold from employees to fund this. But at least based on my experience in the past, it starts as a relatively low tax rate. And as they find the demand is higher than what they have for benefits to pay out, the tax goes up. So stay tuned, and hopefully it doesn't get crazy.
And with that, once again, Mike and I thank you for joining us today. As I said at the beginning of the presentation, we'll work with the South Windsor Chamber to circulate this slide deck to anybody who registered for the webinar. And Mike and I have our contact information on the first slide. So unfortunately, we couldn't get to your questions today, but if you have any questions, don't hesitate to reach out to us. And thank you, Mike, for co-presenting with me. Happy New Year to everybody, and a better 2021. Take care.
Thank you, everyone.